F5. Okay. Good morning. It's my privilege to can address this audience and to give a short survey what's going on in the field of employee ownership in Slovenia in the latest time. Thank you for your invitation. In the aftermath of the general privatization in all post-socialist countries, the volume of employee ownership has declined very rapidly. But, as quoted yesterday, Mark, we have still 4.5% of the capital in the hands of employees. That's encouraging. But it takes a decade and the efforts of non-governmental organizations such as Dezap and trade unions to come to a law about the financial participation of employees. The law is called Participation of Employees on Profit and was approved by the Parliament in March 2008. This law is still valid in Slovenia. However, in 2009, the first signs, let me say, business activity declines, and the first signs of crisis appeared. At the same time, some cases of enormous enrichment of certain people came to light in Slovenia, contrary to the relatively poorly paid employees. This causes an awareness and demand for more justified distribution of wealth. An analysis was made about the implementation of this law on participation of an employee on profit, and the analysis had shown that only 24 plans were registered under the present law, in which only 0.29% of the total number of employees participated. The possible causes for weak implementation could be not sufficient time for bringing profit sharing into the practice, lasting procedure to implement the law at the level of companies. The management did not respond to the employees when the proposal was submitted. Employees were not motivated to wait 1 or 3 years to be justified for tax reductions. Companies preferred to use more simple ways to reward their employees, such as certain salary or Christmas money. The daughter companies at the composed companies were deprived of the profit by mother companies. The law was not used even at partially state-owned companies. At the same time, the employers presented their willing to implement the law in a larger scale when the entrance procedures to the plan would be simpler. Under the pressure brought to bear by trade unions, political parties, the government has forged out a new law. And the important stipulation regarding the problems, or considering the problems with the old law, and also taking into account the different or the changed economic situation, which calls more for for spending than saving. And the most important stipulation of the new law are the registration of the contract or plan is carried out simply by notifying the Revenue Office. The company can use either cash or share scheme or combination of both. The contract or plan can be made on the level of the mother company. The gross average salaries can be paid out, but not more than 5,000 euros by participant. There is not more 1 year or 3 years delay as a precondition for the tax allowances. The profit paid out is completely considered as tax reduction, and no contribution of it have to be paid for social welfare or at the company level. The participants have to pay only 50% income tax of the acquired profit and no contributions for social welfare. The participant must not dispose of the acquired shares for 3 years. The acquisition of shares at the reduced price is also considered as a share scheme. In the procedure of this law in the Parliament, some member of parliaments, even pertaining to the ruling party in the government, have succeeded to put to the law an amendment which calls for obligatory profit sharing. The amendment requires obligatory distribution of the profit among the employees when the company distributes more than 25% of the profit. In that case, 25% of the distributed profit must be paid to the employees. And this causes the problems. According to the Constitution of Slovenia, each law must be approved also by the State Council, that is somehow a second house of the Parliament. And when rejected by State Council, the law must re-enter the procedure, and in that case, an absolute majority of votes must be acquired to bring to the force the law. The arguments of the State Councils for rejection, of course, the State Council has rejected because of this amendment the law, and the arguments were the compulsory profit sharing is interfering with the